Seed Enterprise Investment Scheme, Enterprise Investment Scheme, more commonly known as SEIS or EIS. Today, I'm going to explain why these are super attractive to investors, but also why, as an early stage business or a startup business, these are really important to have in place to make you more attractive to investors. In the comments box, there's a link to our website where you can book a discovery call with me free of charge if you want to discuss anything that you see in this video or want some more information, or indeed anything in terms of accountancy, tax, finance for your business. Don't forget to like the video, and also don't forget to subscribe to our YouTube channel, and you'll see more content like this on there in the future. So let's get into the detail of what SEIS and EIS are. Well, fundamentally they are the same thing. There's just different limits and different percentages, which I'll touch on what they are. But when I refer to SEIS and EIS, they're pretty much the same. So as I mentioned at the beginning, they're known as the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme. And they were tax incentive schemes that HMRC put in place to attract investors to put money into startups or early stage businesses. For an investor, they're a massive tax break. And in some cases, when you're raising money, some investors, unless you've got this in place, they won't consider you to invest in. So that's why when I speak to clients who are looking to raise money, I always say, look, it's really, really important you have this, because it just makes it easier for you to attract investment. And also, if there are investors there that do like you, but you don't have the assurance that you've got the SEIS or the EIS, it's going to put them off. So how do they work and how do you get them? So first of all, I'll cover how they work. If you invest in a company that has SEIS or advanced assurance, HMRC will give you a tax break on your tax return. So just to keep it simple and use simple numbers for easy maths, if you've got the SEIS advanced assurance and as an investor, I put £100,000 into your business, the taxman will allow me to write off 50% of that investment against my tax bill. So if my tax bill was £50,000 and I put £100,000 into your company, I'm able to completely wipe out my tax bill. So you can see it's a super attractive tax incentive scheme for an investor. EIS, exactly the same, it's just a different percentage, it's 30%. So what do you need to do to get this in place into your business? Well, what you need to show an investor is an advanced assurance letter from HMRC. So how do you get that? The process itself is quite simple. There's a very simple form that you need to fill in. It's on the HMRC website. The form itself, as I said, it's not complex, it's very straightforward. What is key is the information you send with that form. So HMRC are asking for a pitch deck. So this is the deck that you will use to attract investors. The business financial forecast, and HMRC do want to see that. They want to see all the workings. They do go into that in a lot of detail, which from recent applications we've done for clients, we've seen in the past they maybe just skimmed over it, but now we know they are going into a lot of detail. So it's critical you have those two things. They'll ask for the proposed shareholder agreements and memorandum articles of your company that will be used once the investment's in. And they also want to see a list of investors that are going to invest in the company. This bit is a little bit odd because you are looking for investors and they will only invest in you if you've got the assurance, but you haven't got the insurance, and to get the assurance you have to have the investors on board. There are ways around it, and also an investor does give their name. They don't have to commit to investing. That's one thing to bear in mind, but there are other ways around it. And again, if you wanted to sort of discuss this with me or find out, you can book a discovery call with me. But one of the things I always say is don't even bother applying for it if you haven't got that pitch deck and your financial model. They are critical because HMRC are looking at that. In terms of timing to get it, HMRC will say once you've submitted the application, don't contact us within 30 days. From experience, 30 to 45 days before you hear a reply. And if they've got more questions, then the whole process could take about 90 days. The key thing is getting everything in first time so they don't have to ask any questions. And that's where the experience of someone like myself would help, because we'll be able to know what they're asking for and maybe preempt some of the questions, and in the application we would try and answer those. I mean, sometimes they still have more questions, but the aim is to try and get this through as quickly as possible. So using our experience to do that does help. But yeah, if you work to a window of say between 45 and 90 days to get the advance assurance from HMRC. What HMRC do, they give you a letter, and this is both for SEIS and EIS, and I'll come to what the limits are and what the differences are between the schemes, but you get the same advance assurance letter for SEIS and EIS. And then that's what you present to investors to say, look, if you invest in my company, you will get this tax break from HMRC. HMRC have assured that you will get this tax break. Once you've got the advance assurance, the investor puts the money in the business. He or she will then need a certificate to give to their accountant to be able to make the claim for the relief. That certificate you need to issue, but you get that certificate by filling in a compliance form. And again, that's a simple form. And all it's doing is HMRC are checking that when you did that first application for the advance assurance, nothing's changed or nothing fundamental has changed. Because sometimes if you've done investment raises before or you're going through one, you know it can take a while and things may change. But the assurance was granted on what you presented in that application. So if it has fundamentally changed, you do need to watch out because it could invalidate that advance assurance. So the compliance check is simply just to say nothing's changed and we've got the money and I want to issue the certificates to the investors. That process is pretty quick. It can take between 7 and 14 days for HMRC to reply, and if they're happy, they'll give you the blank certificates. You fill in the blank certificate, give it to the investor, he or she will then give it to their accountant and they do the rest and they get the big tax refund. So pretty straightforward, to be honest. I think the key areas are just knowing what to submit to HMRC and trying to get that process as quickly as possible so you can preempt some of those questions. So what are the differences between SEIS and EIS and what are the rules? Well, the rules around it are that with SEIS, you can only have up to £150,000 investment to be able to get that relief in one company. So if your company has a £150,000 limit, they can have as many investors as they want up to that 150,000. So it could be 1, it could be 2, 3, 4, all different amounts. But if that total amount of investment comes up to 150, those investors that have put into that company up to £150,000 limit can only get SEIS relief of 50%. The EIS is 1.5 million. So that's one of the main differences of the two schemes. Say for example, they put in 200,000, 150,000 is eligible for SEIS and the 50,000 is eligible for EIS. So they still get a decent tax break. And it doesn't matter if you just raise 150, you then move to the EIS bracket and that's up to 1.5 million. So that's one of the key differences. The other I touched on before was the percentage. So it's 50% that you can claim up to 150,000 in the company, and then under EIS it's 30%. There are lots more rules which are like what the money should be used for, asset values in terms of what the company has on its balance sheet, and also in terms of how the money is used and when it's used, because the money has to be spent within a certain time period. I won't go into all those details because, as you can imagine with HMRC, there are lots of rules. One little tip, if you do want to find on the internet, the HMRC website is really good. It explains the rules quite well, and also there are other sort of explainer videos and other things that you can find. But if you Google SEIS or EIS, for some reason Google doesn't come up with a seed enterprise investment scheme, or at least from my experience it doesn't. It comes up with a Swiss visa application for some bizarre reason. But anyway, I would recommend that you type in the full seed enterprise investment scheme or enterprise investment scheme, and then it'll come up with the right page. So there's just a little tip on that one. But then in terms of other things that are different with the different tax schemes, EIS and SEIS, is the window of the time limit. So SEIS, you've got 2 years to raise the money, and EIS is 7 years. Now you can have EIS companies which are R&D intensive, and there's different rules and different limits. Again, I'm not going to touch on those, and you can find them on the HMRC website, but I'm just talking about just standard EIS and SEIS. But the R&D one is something to bear in mind if you are a very tech focused business, because the limits are very different with that. The rules are still the same, it's just the limits. This window though, these 2 years and 7 year windows, there's some real key things to look out for. So when does the 2 year window start for SEIS? Well, it's actually from your first sale and it's not from when you incorporate the company. So if you incorporate the company and then for a year do no sales because you sort of build everything, raising money, etc., the clock doesn't start ticking from day one. It starts ticking from when you raise that first sales invoice. Something just to watch out for on that though is when you do raise a sales invoice. So it's caught out a few people we've come across before where, say you've done a trial and you've just raised an invoice, like a paid for trial for something, or if it's a consultancy fee and it's not really what you're doing for your main business. But HMRC will deem that as a sales invoice and the clock starts ticking. So really be careful with that, because you could do all this and tell investors, yeah, we've got advance assurance, and then when they do the compliance check, they can say, actually, no, you've not, because you did a sales invoice over 2 years ago and you don't qualify for it. The same applies with the EIS. It's just 7 years, just a 7-year window. That's it. So that's the main fundamental differences with the two schemes. So in summary, I do think they're super important to get if you're raising money. It's so competitive to raise money for your business. So if there's any little wins that you can get to be able to put you above other companies, then this is one. And it's a really attractive scheme for investors. And some investors will not invest in your company if you don't have it. So it's really important. So as I said there at the beginning, in the comments box, there's a link. You can book a discovery call with me if you want to discuss anything in this video, if you want to get more detail, or if you want help with the application, just contact me through that link. And also don't forget to subscribe to our channel and you'll get more useful videos like this in future.